Hi everybody, this is Jay with CassidyInvestments.com with your note tidbit for the week. The note tidbit for this week has to do with what I personally like about note investing. I'm covering 4 facts this week and 4 additional for next week. The first thing that I like is the fact that notes are contractual versus volatility that takes place within the market. Markets can swing on emotions so much, so fast. And with notes, it's a contractual agreement which is has the set terms and predictability to it. The analogy I always make is the old fable of the tortoise and the hare. The tortoise is very much like notes, consistency and predictability, whereas the hare is often the markets, you don't know where they're going. And at this point in my life, predictability becomes really important, all right? Because time is not my friend as we all get older. And if we have a bad year, a couple years due to a recession, we may not have time to recover. So consistency, predictability is a high priority. The second thing I like is the fact that the paper that we hold is backed by real estate. All right, and that is a tangible asset, whereas when you're looking at the market, it's often just paper assets. The third thing then that's tied with that real estate is that when you're buying, right, we buy at a discount so that we have equity in the property that would protect us if we would have to take the property back. That gives us a security, all right? If we are buying at a steep enough discount, the investment to value of the property may vary based upon what the valuation of the property is. But if you're buying at a steep enough discount, you have plenty of equity even with market fluctuations, that will protect your investment. And return of investment is the first priority to make sure that, or I should say preservation of capital is the first priority before the return on capital comes back. The fourth thing then, from my standpoint, is the fact that I like that I'm getting both interest and principal back so that I can turn around and reinvest that and start creating a stacking, or think of a bond laddering type of scenario, that you start creating a snowball effect of where this starts rolling over faster and faster and faster. And it really doesn't take that long until that starts to happen for you. So hopefully you find those four facts helpful. All right, I'm going to cover 4 more next week. If you'd like to learn more, we encourage you to sign up for our quarterly newsletter. You can do that at our website at Cassidy, that's CASSIDY, investments.com. And then you can also sign up for our monthly Note Talks with Kyle and Jay, which is always held on the last Thursday of the month from 12 to 1 Eastern Time. And just by signing up, you'll get the link of the recordings if you can't be on it live. So with that in mind, we hope that you have a fantastic rest of the day, and we'll talk with you soon. Catch you later. Bye-bye.